Good evening, everyone. It's about 5:02. I'm going to go ahead and give all the participants who are logging in to the webinar, I'll give them another minute or two before we get started with today's presentation. Alrighty, I can see participants already logging in, and just to be respectful of their time, we're going to go ahead and get started now. And then for those who join later, I will just make sure that I type into the chat box to let you know what some of the housekeeping items are if you have a question. So again, good evening and welcome everyone. Thank you for joining us this evening for the fourth webinar of our Your Pathway to Home Ownership webinar series with Bank of the West. We call it the Banking Basics. I'm Suhey Mojica. I am the Business and Housing Program Manager of the San Pablo EDC. And presenting with me tonight will be Emma Biggie from Bank of the West.
Hi, everybody. Good evening. This is Emma.
Thank you, Emma. And just before we turn over the mic to Emma, I just want to let you guys know that before we get started, we have a few housekeeping items. If you have questions, please submit them in the Q&A box, which is located at the bottom of your screen, or you can also send it through the chat box. This session is being recorded, and you will be able to watch this webinar again through our on-demand links on our website. And so just keep in mind that everyone is muted and your information will remain confidential. That's why you only see the presenters here on the screen. We will answer your questions during and at the end of the webinar. So please feel free to type in your questions as we are going through the information. And just to let you guys know, just a little bit of background in regards to what the San Pablo Economic Development Corporation is. We are a full service organization for economic growth in Contra Costa County and Alameda County. We're here to help you establish the critical connections that you need to succeed in our diverse business ecosystem, as well as we provide a broad range of affordable housing opportunities and services to enable low to moderate income residents to gain better housing and financial stability. We also offer various workforce programs from career training funding, childcare funding, for working residents, on-the-job training, and much more. As you can see here on the slide, these are some of the services that we provide here at San Pablo EDC. And if you have any questions in regards to any of this information, please feel free to contact us. I will have our contact information at the end of the presentation so that you can connect with us or with Bank of the West if you have further questions after this presentation today. And before we get started with Emma, I just want to give you guys a little bit of a background in regards to who will be presenting. Emma is from Bank of the West, as I mentioned before. She is the VP Community Lending and Diverse Markets Business Development Officer. And she will be going over just the banking and borrowing basics on how to prepare if you're looking to become a first-time home buyer. So I'm going to go ahead and turn it over to Emma, and she'll start sharing her screen.
Thank you, Sohee. Thank you very much. Again, good evening, everybody. It's very nice to have everybody coming to our workshop. I am going to share my screen. As Sohee mentioned, This is Emma from Bank of the West. I have been in the lending business for the past 20 years. Tonight, what we are really talking about is going to be lending basics / home equity. We're related to our home buying, home purchasing there. Okay, so with that said, let's stay slideshow from beginning. Give me an okay, you can see the slides. Yes, wonderful. Thank you very much. So again, Bank of the West is my current banking company I work for. I have been here for 5 years. Basically, we are quite a different bank. We're a regional bank and serving the community from A to Z. And also we are very environmental conscious bank. We give back to the community for support planet, the community safety and humanity. So that's why we said we celebrate strength through diversity today and every day. Now, get to our corporate is borrowing basics and home equity. The workshop structured a little bit to first talking about some lending basics, and then we're going to specify about home equity piece. Before we go into dive in the lecture piece or discussion piece, I would consider to say what we can, if we are going to apply for a loan, and what we can be improved by our capacity, capital gains, credit, or creditors. And that's something there to take. I put some points on the table, so everybody looking at this slides, just take in this information and then think about it. So this type of information is going to be talked and discussed in our further going progress the class. Most of loans are set up the same, is really. So that's one thing. The other thing is Federal Truth in Lending Act or TILA disclosure can help you compare loan options from different lenders. Is that true or false? Yes, and so he's also in the chat setting is if you have any questions, put in the Q&A so we can answer that after the class. Well, without further ado, let's start moving on. So basically tonight we're going to talk about the two sections. The second section is fairly small. The first section, basically a lot of things involved practical lending piece. So ways to borrow money and what it costs. So this is the major thing we're talking about if we want to borrow money in general. What's the main thing when we're talking about the borrow money? Of course, from a borrower side, we want to get the money, right? Because we want to borrow the money, we wish somebody can give the money we want to have. So that's our big thing as a borrower side. But flip side is if we borrow money from somebody, that somebody also have some certain consideration and concern for the borrower. So what's the really concern? What's the real concern in this whole borrow money situation is to make sure the money is going to be paid back. Well, for the borrower, we also want to be sure we borrow the money, we can pay back the money we borrow. In that case, as a borrower, we do need to know how much we can borrow and how much will cost us to borrow money. And if something happened, I cannot pay back. And what's the result? What's the consequences out of that? Talking about the borrowing means is lender provide money, and then we promise we're going to pay back the money plus the cost to use that money, which is translate the word specifically, we call it interest. Here is the thing. In the lending business, credit is the way we're talking about the ability to borrow money. From lender side, how much credit we gave to the borrower. That's how much money from a borrower side can borrow money. And the debt is, of course, the person own the other party's money. How much is that? And talking about borrow money, we got to understand the loans, right? Once we get into the relationship of a borrower and the lender, that relationship is a come to the agreement, the contractual agreement, which is the loan. This type of a loan can be applied into borrow money against car, against some services, against the house, or against some equipment. So in this situation, we're talking about a borrowing, talking about the loaning, talk about the lending. So it's not a specific on what type of a loan we're going to get. We're going to get that in a little bit. So let's go through the basics and then we go to the home equity piece. Installment loan basically is talking about a borrowing, talking about lending. We have two fundamental things, specific how to structure, design this borrowing lending product, which is loan. One loan is we call the installment loan. What is the installment loan? Usually is the loan is designed to borrow one chunk money out and planned to pay back by the equal payment or segment to pay back. And that's what we call installment loan. Install means is one chunk, one piece after the other. So usually be paid back equal payment over set of a period of time. And normally because of the installment loan is a fixed chunk, you can think about it in the physics type of situation. You have a lot of wood bricks here. So you borrow a big chunk of a tree. Well, we're just using that big chunk of a tree. And then when you return back, you chop the tree in a small blocks and going back, and every block is equal weight, equal size. So after you return all the blocks back, your money is paid back by the set time. Because of that nature, normally the cost of that loan is fixed. In other words, the fee is fixed, the interest is fixed, and because it's easy to calculate for a purpose of each block and set. Now the next type of a loan is opposite from this installment, from the fixed block type of a payment or structure payback. So revolving loan is at the beginning, it can be a whole chunk of money out or can be partial of the money out. Regardless is a whole chunk or partial money out, when you pay back, is not required you have to pay by the set a piece, can be flexible. So the payment can be dependent on how much you have borrowed. That's why is if you didn't borrow up front that much, that means is you may borrow partial, you only return that partial. So this type of a borrow is especially related to our credit card, our any revolving, means is revolving is open end. There's no ending. It is constantly you can rolling this money going forward. So you can borrow and you pay back, and you can pay back and borrow at the same time. So it's constantly going, and there's no end until to reach the set time. So credit card is an example. And the other loans, the other side of loan we're talking about is line of credit is also revolving, because line of credit is open-ending loan. Now, talking about the loan nature, we know the loan is going to be borrowed and lending, right? And we know either is a fixed or is revolving, is open ending, is not a fixed. Then you look at the nature of the loan. The loan has to related to the borrowing concept. Either we borrow per the agreement is tied to concrete tangible goods, means is equipment, furniture, house, car, all those type of things. Or they can do is there's no collateral, not tied to tangible goods. In other words, it's just basically based upon a contract. So for any loans, borrower relationship, if we tie to the solid tangible goods, we call it is a secured loan. The secured loan, there's a word is going to be used is collateral. The collateral means is you're using something to substitute the money, such as house, vehicle, or any other things. If you lose the collateral, that means if you don't pay back the contract, the collateral is no longer belong to you. That collateral is going to cross the line to go to the lender piece. So in other words, is lender is going to using the collateral to exchange the money. Unsecured loan, as there's no tangible goods attached to it, so basically is a contract. But just to remember, non-collateral loan, because there's no tangible goods attached to it, number one, is a little bit harder to get it. And number two, because it's a little bit high risk, there's no tangible goods attached to or supported. So the rate or the fee charged to borrow that money is a little bit high. In other words, is a lot of those non-collateral loan or unsecured loan we called, the lender normally requires some certain insurance. And that's why that type of loan, cost of that type of loan is a little bit high, because that will go, some of those money actually for lender is considered to do the insurance to secure some money be paid back if the loan is default. Here is how we calculate. So what do you generally pay more money than you borrow? This is a very important to understand. A lot of people say, well, I borrow money is $10. I know I return your $10 and you charge me interest, but overall actually will cost the borrower more, because why? You borrow the money, that's cost you something, but also cost to spend the money to get that money. So this is typically when we calculate how much money we're going to spend to borrow this money, we got to consider to calculate everything together. We cannot just calculate the principal, because the cost associated to that loan, that's also out of the borrower's pocket. This is very, very important. Actually, be more specific, we have using a specific words to identify this piece. Principal is the money we borrow. Interest actually is the money the institution or lender charge you to use that money, translated to charge you by the interest. The interest is going to charge for the whole time you borrow the money. And then the fee also be part of that. What's this fee? Here is implied the activity for the transaction. This type of fee can be charged momentarily just for the transaction, is not for the whole term of the loan. So that's the difference between the interest. It's the same thing as the cost of the loan, but it's a one-time fee or two times fee. So those type of things can also be included in the cost of a borrowing. Repayment back, that's basically is talking about it. If we borrow money, we gotta make sure we pay back the loan. So here is the thing. if we pay back the loan, remember this, if we pay back any principal, that paid back the principal won't generate more interest for the rest of the term. So that's why when we borrow a loan, if we prepay the loan more than we scheduled payment, you actually pay the loan back quicker. You finish the term quicker. That's the reason for that, because we paid back the principal. So once you put more money back into the loan, the principal paying down, your interest goes down, you pay more principal, apply more money to the principal, and your term is getting shorter. So that's something for our people to understand the borrower piece. Another thing talking about the borrower thing is when we borrow the money, lender has a lot of authority to say things, to set up the condition, to set up the guidelines and restrictions. So certain loans can have prepayment penalty. A lot of people don't understand what this prepayment penalty set for. Just to give you a hint, behind the curtain, if I am the lender, right? So if I set a prepayment penalty, what's my intention here? My intention is to generate more interest payment for me, to make more money out of this lending relationship. But also from a buyer side, you would see that phenomenon as somewhat, if the lender set up the prepayment penalty at the beginning piece of the loan, then normally the interest rate can be a little bit lower. We in the lending business, we call that can be a teasering rate lending at the beginning. Basically is we attract the people come in to lend, to borrow money. And then once you borrow the money for the set up the initial period, and then after that initial period, the interest rate can be changed for a little bit higher to manage for the whole term. And that's also, if I set the interest rate lower for some time, I may put a prepayment penalty for that time, for the initial time, to avoid the people just taking advantage for the lower interest rate, because the money has to cost the lenders money to generate the income to open the business, to keep the business going. So that's something is behind the curtain. For our general consumer, we do need to understand there's a lot of things behind why lender designed the certain program with certain features, because there's a reason. And the bottom line is lender is considering lending is a risk business. So for the risk, they have to use a certain money revenues to balancing that risk. Here talking a little bit about how the lender designs certain documentation to help borrower to understand the loan, and also compare the loan program to really see which one is economic, or in other words, is cheaper loan, which one is expensive loan. Because money in lending business, especially in the financial world, the lending business, the money itself is a merchandise. This is not just like we go to grocery, we buy the potato, we buy the tomato, we buy the celery. We can see what is look like in size, shape, color, taste, everything, and then we can do the evaluation. In the money business, money itself is merchandise. So how are we going to evaluate the value for the borrower borrowing piece? So we have to design a special system to tell everybody how we can compare the loans and what to compare. In the lending business, choosing lending, which is nowadays, especially in home lending, they change that also into a disclosure to tell the consumer the loan terms in very, very crystal clear format and also uniform manner. In other words, is you talk to 10, 20, 100 lenders, their disclosure is the same term, same format, and tell you what it is. So in that case, you know, because the structure is the same, you come in, you see the exactly format, and you just go to the certain spot and to see the number. If the number is higher or low, that's basically a mess. If a 2 is apparently higher than 1, and the 3 apparently higher than 2, and you know which one is economic, which one is more expensive. The most important thing is, as consumer, we do need to understand somewhat is why that loan costs more money, what drive that cost. And that's something you do need to read this type of disclosure, or what we say is Truth in Lending Act, because everything disclosed in this documentation, and you should see that in clearly language. For example, if on 2 loans compared together, what we'll see exactly loan amount is $100,000 for loan A and loan B. The first A loan has 4% interest rate. The loan B has 4% interest rate. Just by looking at these 2 items, you see there's no differences. Truly, there's no differences because they calculate the interest rate is the same thing. And then you goes down and to say, well, they are APR, which is annual percentage rate. That's column. You see the loan A is 4.75 and the loan B is going to be 5%. Now here is the interesting piece. Why is exactly same interest, exactly same amount, your annual interest percentage is one is lower than the other? Now we need to look at the detail. What is the annual percentage rate? That percentage basically is talking about this loan annually, how much total cost for the buyer to get this money, and using the percentage rate to reflect that cost. So by saying that, you know the loan A, 100,000 with 4% is cost less than loan B. That's already tell you there's some other fees must for the lender A is charged less than the lender B. This is actually is an example is talking about annual percentage rate is 12%. The dollar amount cost is 600 and the amount of principal is 5,000. So the total payment is going to be 5,600. So that's something is just in compliance with what I said earlier. When we talking about borrow the money, how much to cost us to borrow the money, we need to looking at the whole number. In this case, the principal is 5,000, but the cost for us is 600. So the really total cost is 5,600, is not just 5,000. And this is actually is giving you a little bit of specific what is cost this 600, where this 600 talking about or coming from, how this coming from is your 12% times the 5,000 come to 600. So that's the total everything. Now, with that piece I giving everybody, this is the basic understanding we already know. So we know there's lenders exactly same loan amount, same interest rate, they charge different. So what's that telling us? The whole situation telling us is we are borrowing money. It's just like we are going to ask for other things to we need to shop. We need to find the resources will meet our consumers' need. So if we shop for clothing, we shop for car, we shop for grocery, everything in our life we shop for because we want to do saving, or we want to be just practical, to be economic. And then borrow money is the same thing. We need to talk to the different lenders and find out what type of a program they have. Talking about if a lot of our borrower consumer to say, hey, I may need a more understanding and the education on this. Guess what? You're not alone there. Don't feel, you don't know where to find the help, where to seek the help, where to find the information. In this classroom, I am your resources. Of course, I'm coming from the bank, but I'm also a financial service center. This service not only for financial services, we also include education services. We have the information to provide to educate people. That's also part of our function, business function. And also, Songhe, the San Pablo EDC, that's the housing agency, that's the business developer training facility. They will help our consumer to understand a lot of financial practices or business conduct to really provide the information for us, understanding some basics. So that's pretty much is talking about section 1. What is the key main point about borrowing? Borrowing is to get a loan, we need to know how much we can afford a payment. And that's involved how much money we make and how much money we feel comfortable we can borrow and pay back. And just remember, we're talking about payback from consumer side. We're asking ourselves how much we can afford to borrow. And from the lender side, they also consider how much we can borrow and pay them back, because pay back the loan is not just to pay back the money. It's involved our background credit, and also for the lender's piece is lender's risk, whether that money can be reused for other people, because money is considered merchandise recycle in the system. So if as a consumer we borrow money, we pay back, that's gave lenders back the money. So the resources is always cycling and to refresh, to refund the money to other people. So that's a lot of things involved here. Any questions on the section 1 piece?
No questions so far.
Okay, wonderful. So let's go to the section 2. Section 2 actually is today's our related topic. We're talking about home equity, especially, San Pablo EDC and us, Bank of the West. Nowadays we are highly advocate and support home ownership, because we know home ownership is a fundamental for building family wealth. And building the society is the foundation of the society. So there's a lot of the things go in there. Specifically, we're talking about, especially when people obtained the home ownership, and then what? How we are going to sustain the home ownership. And this is the piece we actually for the second section we'll talk about. It's not a long piece, but it is the core piece. Has everybody already know home equity, right? What is a home equity? I just want to give 3 seconds for everybody to ask this question. If you are a homeowner, or maybe you are not homeowner today, but you in the past, you did own the house, do you understand what is home equity? Home equity basically is the asset you have on the house. that piece of asset is a pure asset, because what we say is asset, that means is they are not going to be the backup to support some other lending vehicle. In other words, is if you have, or just using simple numbers here, if you have a house worth $100,000, you do not have a loan, you did not borrow money to purchase the house, you didn't own anybody using the house as a collateral. We talked about it in the section 1. Now I want to ask how much equity we have. We have a pure $100,000. Why? Because you own the house free and clear. You don't own anybody else. You don't using the house, get it in debt. Now, same scenario, same question, but we're changing the number a little bit. We still have owning the house $100,000. Well, we borrowed the money to purchase the house. We own somebody for $50,000. Now we're looking at it, how much equity do we have? In other words, what is the asset we have on the house? We know we only have $50,000. Why? Because the house worth $100,000. We borrow we borrow $50,000. If we're going to give back that $50,000, we sell the house, we only rendered another $50,000 in our pocket. So the pure asset is only $50,000. So now you know what equity means. Equity means is the difference between the home value minus the debt owned to other people on the house, on the home, or on the real estate as homeowner or investor owned. So with that said, we understand equity. Now, in reality, as a homeowner, once we obtain homeownership, this is for the homeownership class, we always telling everybody, we want to pursue the homeownership. We want to own the homeownership, because own the homeownership, we build family wealth. But where's the wealth coming from? The wealth is we have to utilize that piece of a property to do something to generate wealth. That's the main thing. Home ownership is not you just own the house to put a roof over the head. Because if that's the only thing we understand home ownership, that's actually is a misleading piece. Why? Because you think about this. If you purchase the house, just want to put a roof over the head, nowadays, under today's weather, in this area, we're not going to be in the family wealth. We're talking about the family wealth. We're not even in the family wealth. We probably is talking about a huge family debt. It can be a broke. Why? Because we spend so much money to acquire that home ownership. And probably for generations to return that money back. So what we really need to think about is after we obtain home ownership, own that piece of a property, we need to start thinking how to utilize that property. And that piece is involved to tap into home equity. Well, the people say, yes, Emma, but I'm thinking is I purchased the house today, and I'm going to hold the house and I pay off you as a lender to pay off the purchase loan. And I have the whole equity I'm not using. So down the road, 30 years, 50 years later, I sell the house, I can render the whole asset coming back. Yes, that's true. But also that will take a long, long, long time. During this long time lifespan, put this way, you can actually utilize that liability to do a lot of things to generate more wealth before you reach to render the house to get the equity, to get that total asset. what you really need to do is thinking about how to improve the household finances. And improve the household finances can be using the money to do more things, to do education, to start a business, and also to improve the value of the house to gain the more down the road. So that is something we really want to provide for the people to start thinking. So here listed a lot of home equity, kind of triggering home equity thoughts, how to utilize the home equity. The first thing is debt consolidation. A lot of people said, well, that doesn't make sense. If I use the equity, that means I'm going to borrow against the house again. So I just get myself more into a debt. Yes and no. The yes is you open the new debt on the equity piece. But the no piece is what we say here is debt consolidation. That means we are using that specific liability to consolidate other debt out there, and we're actually paying a high cost for holding those debt. This is very important because a lot of people don't think that way. They think, well, the credit card is very easy. I can just go to the store, scan the card, I got my money. I got my money worth merchandise. I buy anything I want. And then I just keep paying that. I get used to it. I forgot it. But the thing is, average credit card interest rate in the United States right now, I listed here as a 15 and 18%. That's actually is a very conservative calculation because we really do not want to scare people away. Guess what? Nowadays, the average credit card cost is already reached between 23 to 26% average. And you see, you pay that high interest, and compared to you do the home equity loan, a lot of time the interest rate is much lower because it's tied to the house. That's the first section we talked about. It is collateral. Once you have a collateral loan, the interest rate is normally is lower. Why? Because it tied to a tangible goods. So the lender feel more comfortable to lend money out. The risk is lower because we are in the equal transaction. With that said and also with that said, that means you actually use equity, the lower interest rate, to consolidate high interest rate debt. And that's a winning for the people to manage that finances. And this need a little bit extra calculation. If you do have a credit card, and especially you have a credit card high balance there, I highly suggest you go home and take out the bills and looking at it. And looking at it, especially not looking at it this month or last month, you're looking at your averagely carried balance. If your average carried balance on that card is a little bit high, over 1,000, 2,000, even 3,000, you definitely need to look at it, how much you pay the interest every year. And that money actually is throughout. The most important thing is for the home equity loan, the interest you paid that actually is tax deductible. You can get that tax back on your personal tax filing. So that's gave you the tax shield, we call it is tax benefit. That's specifically why homeownership is important, because you can borrow money to purchase the house, but to borrow the money, borrow the money, you actually can get a tax benefit to offset on the other side. So that's why you can gain some money back. Of course, we talk about homeownership, home improvement. This is a pure talking about to improve your value of the house, because a house is deteriorating. The property is deteriorating. Every tangible goods has a deteriorating nature. So for maintain the value of the house, we got to do a repair all the time. So with that said, we need to repair, and using the house to repair the house, that makes sense. You do not need to do other things, and the house repair will be paid back by itself. And the future use, we already talked about this, is you can use the money to do business, to do education, to pursue some other things, is family interest, can open the door for future building the wealth. So that's something for everybody to think about it, how to use the home equity. Well, using home equity, there's a certain conditions. Condition we also need to think about, consider. Number one, using home equity, borrow home equity, or borrow against home equity. The processing, just like you borrow money for any other things, for especially for the house, is similar. The processing is similar. Even how the lender identify the qualification is similar. They ask for similar documentation. The decision procedure is also similar. That's number one. Number two, the loan itself applied to what we discussed can be a fixed rate loan or can be a revolving loan. In other words, it's an installment loan or revolving loan. So that's have a flexibility. And also home equity loan, a lot of times home equity loan is going to be issued by a banking with depository function there. In other words, it's not just the lenders are doing mortgage loans. It normally goes with depository. That means is the financial institution has checking and saving, other financial product depository services there tied to that. So the lender can provide that flexibility. Especially give you a little bit of insight is currently home equity actually is a lender's own product. In other words, is the lender has to have enough money reserved to lend those home equity product. So really, you got to looking at the big banks, big depository credit unions, or other depository banking to have that. Some of those loans, some of this product can have some service fee. The service fee, what I mean is to doing the loan maybe as for free, but because of you maintain the loan program for a relatively long time, especially revolving line of credit, the line of credit is going to charge annual service fee or membership fee. So that's something you do need to consider. So that's talking about the home equity piece. And then, of course, a little bit discussion is about to apply for the loan. As I mentioned, is you do apply for the home equity just like you do apply for home mortgage for purchasing the house, because it's tied to the collateral. So the lender is going to looking at the borrower's credit history, the borrower's income situation, the borrower's the reserve money, and the borrower's collateral, which is secure the loan piece, which is the real estate, and all the other conditions is to say whether the borrower's overall conditions will meet borrowing requirement. So this is a very, very identical like home purchasing. If anybody, that's why is when we talk about home equity loan, we always follow the home purchasing workshop. We do the home purchasing workshop first, and then we talk about home equity loan. Why? Because you have to own the house first to talk about home equity. If you don't own the house, there's no equity to discuss, so the loan won't be existing. Talking about a credit character, that's kind of a one way for the lender to really judge for the buyers whether they have some credentials to borrow this type of a loan. If the person has derogatory credit history, most likely the requirement can be denied or rejected, because this type of loan tied to the house, the lender is very, very careful. This is not just like a revolving credit card loans or a regular installment loan, because it's tied to the house. Why is it so kind of special? Because it's a serious business tied to the house. We know that the house is involved people's life, so the lender will be more careful about how to make a decision on the home equity piece. And capacity is talking about is the buyer, whether the future is ability to pay back the loan. The most important thing is what's the buyer's capability to making money, because this is type of a loan is for long term, especially you're doing an involving loan. That's just like a credit card. So the lender does want to say, if you spend money in the future at month in, month out, or year in, year out, is that a possible the borrower can have the instant to default the loan, and do they have enough money to pay back the loan? The asset capital is basically is net worth. So the person does have a lot of savings or reserve money. This may not be, has to be a current cash value, but for long term, the lender does want to see that reserve, the retirement and the future 401ks and the investment, that's all going to be considered as future capital and the asset. And the collateral is very easy, is talking about the property. Just to remember what consider is the definition of a home equity. Home equity is the house has to have that free value, not tied to any debt. So for that reason, the lender also evaluate how much equity the certain house has it. If you borrow already too much out of the house, you may not have too much left to reborrow on the equity piece. So the lender is reserve the right to lend the money out. Also for the home equity, is a similar identical. You can have co-borrower, co-signing is possible, but just to remember, co-borrower, that means is the other person is going to be in the loan together. The co-signing, the person may not be on the loan, they just co-sign for the loan, but they may not be in the loan with the borrower. But same thing, both situation, if you have the co-borrower, a co-signing person, if the borrower is the main person default the loan, the co-signing and co-borrower will be responsible, will be chased for the future responsibility for repay back the loan. And what to discuss, this is easy to identify because we borrow against the equity. First thing is, do we have enough money to pay back down the road, make enough money to do, and are we willing to make that payment? And also we need to identify the future effects will influence or impact our income to pay back the money. So overall, you can see the lender, the main concern is whether you can pay back the loan or not. Believe it or not, a lot of people said, well, since I borrow against equity, if I default, you just take my house. Yes and no. Yes is lender does have a right to redeem the house, but the no piece is, remember this, equity somewhat the lender would not want to get involved to get a house, because there's some scenario the equity can be followed by can follow a big first mortgage there. So that's one thing. The other thing is, if we are going to if the home equity loan is default, the lender will have to think about it is, should we really get into the real estate business? Because lender normally doesn't want to do real estate business. We're money business. Why do we have to handle the real estate? So that's a lot of legal issues involved. So especially for equity piece, the lender will be less willing to get into the default situation. So they would like to see the borrower can pay back the money and to pay back the money voluntarily and have no issue there. So for that, they do have set some requirement for good credit, good income, good collateral, and all those type of situation. So after we talked about this, as we all know, we kind of know each side, the position, what we're looking for, and what the concern is, what the really decision matter. The rest of things is to really have to see, what will I do? You know, if I own a house, I know I have a lot of equity. Should I do something? And I want to encourage that thinking to go a little bit bigger, go a little bit beyond, because a lot of people, they're thinking, I gave you some list to say, oh, debt consolidation and to housing improvement and do some business and all those. But you also need to think bigger. And how about is, if you have a senior person in the household, do you consider to use equity to support the senior person, or even us ourselves to get into a senior age or some medical situation? Would you want to use equity to support that? That's all things you should start to thinking about it. For me, I would plant the seeds for the people to start thinking and critically thinking, and then make the right decision, make the right action plan. With that said, I pretty much concluded our tonight understanding borrowing, understanding home equity borrowing. Are there any questions?
Yes, there is some questions. Let me just share my screen here really quick, just so that we can go here. Okay, and so I guess I thought I had put my video. Sorry about that. Thank you so much, Emma. So one of the questions was, what is the difference between a home equity line of credit and a home equity loan? And which one is the best? And how long, well, I guess there's a three-part question. And how long are these loans for?
Okay, excellent. So line of credit and home equity loan basically is, home equity loan is fixed rate loan, is installment loan. You take a chunk of money out, you pay back by scheduled payment. Once you pay back by schedule, the loan is paid off. And the money is just one time out. So home equity line of credit is different. It's like a credit card. We gave you a line limit and you borrow the money, you use the money, you can pay back and reuse the money. And that term can keep rolling. Both long term is a 30-year. So it's a long-term loan. The thing is, line of credit, the play money piece is only the first 10 years. And after first 10 years, the play money piece is going to be stopped. And the lender is going to evaluate, are there any balance owed to the lender? If there's a balance owed to the lender, they're going to amortize the rest of the balance for the rest of 20 years.
Okay.
So home equity loan basically is a line of credit, and loan is just a revolving loan or fixed rate loan, installment loan. Yes.
Okay. And I guess their question was, I guess it depends on each person's situation.
Yes.
Obviously, we know that the interests have been changing dramatically the past year. So I guess people are asking, if it's a revolving loan versus a fixed loan, there could be a possibility within that time frame that their
Yes.
interest can change
That's
for a
right.
line of credit.
Yes, for line of credit, the rate is not fixed. It goes with market rate. The installment loan is a set rate, so it's not changing. And it's not changing, your payment is not changing. But revolving loan is just like a credit card.
So they can pay it and reuse it, pay it and reuse it if
That's
they want.
correct. So
With a loan, they just get a lump sum and that's what they get, and they just
that's
repay it within their
correct.
time frame.
That's correct. So the revolving loan, the line of credit, you have a flexibility to use the money again and pay back and reusing the money again. That flexibility in exchange of an adjustable rate.
Okay, got it. Well, hopefully that answers that question. And then the other question is, when you were talking in regards to what lenders look at to extend an offer of, credit or to loan the money out, does overall, aside from credit score, your income, does your overall debt affect the interest rate that a lender offers you?
No, that's a very good question. A lot of people, that's a very good question. A great question. So the answer to that is straightforward, is no. Your debt ratio or debt load in the household is only affect your affordability. In other words, is how much money you can borrow or how much money the lender would like to lend to you, but doesn't affect you how much cost you to spend the money. What is impact that or affect your interest rate is your credit.
The credit score, okay.
Yes, and the equity.
And then how about work history? I know they asked about that too.
Work history, here is the thing. Work history is a soft decisioning part, because the longer the history, of course, we will see the person maybe have a stable income. But here's the thing. The employment engagement or employment contract is a voluntary contract. So it's not set by the third party. And also that very flexible, and any buyer can terminate that relationship, or any employer can terminate that relationship. So the longer history just some sort of indicate the stable income, but it is not guaranteed 100%.
Okay.
And also the underwriter is going to see the skill sets required for the employment. Yes.
Okay. So it is a factor, but it's not a major key component of the lending. Okay.
Correct.
Great. Okay, great. I think let me see if there might be another question here. It says, what if you have a co-signer and their credit is not that great? Does that affect your chances of getting approved for a loan?
Absolutely, yes. Alejandro, I do see that too. Is Alejandro, if you have that question, I would consider, if you want to have a co-borrower, the credit is not good, I will question this, is if that person credit is not good, I'm assuming you are using that the person's income to support to get the loan. But you got to consider credit means a lot. If the person is a co-signer, the credit is going to affect your credit.
Okay,
So
so sometimes it could be that maybe they just don't make enough income to be able to qualify for a certain amount of loan. But if you bring a co-signer and their credit's not that great, then it's not going to help your situation.
exactly.
Okay, okay. Well, hopefully that answers that question. And I know that for this, just for respect out of time out of everyone, we've gone a little bit over our time. I just wanted to let you guys and everyone that was here today, I wanted to thank you for joining us today. As you can see here, we do have other webinars scheduled for the remainder of the year. The next one will be in September, and it's going to be on consumer loans programs explained. And it's also through our webinar series through Bank of the West. So yeah, we have 2 more of these webinars scheduled for the remainder of the day. The year, sorry. So if you would like more information from either San Pablo EDC, like I said, we do have many different housing programs. If you are looking for down payment assistance, we do administer 2 programs here, and you're more than welcome to go into our website, take a look at those programs. And if it's something that you feel like you need help with, or you want to connect with us to see where you can start and get yourself ready to take the opportunity to use this down payment assistance programs, please definitely give me a call. My direct number is here on the screen. If anyone does want to get in touch with Bank of the West or someone at Bank of the West, I do have one of the mortgage bankers here, but there's other ones that we can connect you with that are more either local or close to you. You can just definitely either reach out to me, or I have Mary Beth here, her information. But you could definitely reach out and we can connect you with someone that can help you with further tools and further resources. So again, I want to thank our presenter, Emma Biggie, for sharing such great information and resources. And thank you to everyone that joined us today. Again, have a wonderful night. And if you want to connect with either one of us, please do so. We'll be more than happy to answer any further questions that you may have or connect you with resources. So I don't know if you want to say anything else, Emma, before I end our webinar.
Thanks, Sohi, have me here, and thanks everybody to join this workshop. I hope what we talked about here really provides some useful information and to help you understand some of the lending basics and carry this information, apply this information in your day in life and in your transaction and talking to the lenders and financial institutions. Thank you, everybody.
Yes.
Good night.
Thank you, everybody. Everybody have a good evening. I hope to see you in the next one, actually. So thank you.
Definitely.
Have a good night. All right.
Bye.
Good night.